We're going to hear from a lot of central banks over the course of the next month, which will really set the tone going into the end of the year. Many of these central banks are near the end of their tightening cycle. Some are at the end of their tightening cycle, even if they may not necessarily admit it at this stage. I think the Fed can safely be put in that bracket, the Bank of Canada and RBA as well. Others still may have a little bit of work to do, and I think the Bank of England is very much one of those. We heard from a few policymakers at the Bank of England yesterday, including Governor Andrew Bailey. This was at the monetary policy hearing in front of the Treasury Select Committee, where they get questioned on their monetary policy, what they've learned, what they've done, maybe what they would do differently. And from what we could hear yesterday, I think it's quite clear that there's a lot more balance in the debate now. You can see clearly from Andrew Bailey's comments and those of his colleagues that they don't believe that a rate hike at the next meeting is a foregone conclusion, that there are reasons to be optimistic. We are seeing signs of improvement on inflation. I think we're starting to see signs of improvement on the labour market as well. And as they've alluded to, wages will ultimately come last. Wages will catch up in the same way that it took wages longer to accelerate to the levels that they have done. After inflation, when inflation comes down, I think wages will follow shortly after. So I don't think that's too much of a discouraging element. If the labour market continues to slacken and if inflation continues to fall, I think the Bank of England will feel more than comfortable pausing the tightening cycle and even maybe cutting rates even before wages get back to what's deemed to be a more sustainable level. But we're not quite there yet. As you can see from here, this is the Bank of England interest rate probability, and you can see that markets are still heavily pricing in a rate hike at the next meeting. That's the first thing. And the other thing you can see here is that another rate hike is also priced in at some point in the future as well. So markets still believe there's two more rate hikes to come. I'm not sure the Bank of England would necessarily agree, but I don't think they would strongly disagree either. I think one rate hike may even be more likely than two. And I think that we could potentially see a pause after the next rate hike as well. But a lot of that will obviously depend on the economic data. Markets still think there's two, despite what we saw and heard from the Bank of England yesterday. The other key event yesterday was a piece of economic data from the US. Now, I always say surveys tend to grab attention. They're forward-looking. They give you an indication as to what's to come, but no more so than the ISM survey. The ISM surveys tend to gain a lot of traction. And we saw yesterday that that was the case as well. We saw the ISM Services PMI. Remember, the services sector is the largest sector in the US economy, accounts for more than 3/4 of the US economy, so widely followed. And we got the strongest reported reading since February. So we've seen a strong bounce back in services over the last couple of months, aligned with improved spending from households as well, which suggests that we are seeing that additional resilience in the US economy once more, maybe a little bit of a recovery as well. Maybe those people expecting recession were a bit preemptive here, and maybe the US economy is on a slightly sounder footing than thought. Now, there's two things we can think into this. One is that avoiding a recession is a positive thing. A soft landing becomes more likely, but also, as we saw from yesterday in the markets, it may also mean that interest rates have to stay a little bit higher for a little bit longer. But that Services PMI certainly gave the dollar a boost. As we can see from the chart here, the combination of the dovish Monetary Policy Committee at the Bank of England, which is bearish for the pound typically, and the stronger US data, which is strong for the dollar, meant that the pound-dollar pair moved lower. That is what you would expect to see in that situation. But it's more than that is significant here. The reason why is a few reasons, to be honest. One is that it confirms the shallow retracement that we saw in August. So when we hit those August lows, we retraced back to 128 off the 55-89-day simple moving average band, which at the time, the purple moving averages were acting as a support zone. Then we retraced to the 38.2 before moving lower and making new lows from there. A 38.2% retracement is very shallow. So typically it's a very bearish indicator after such a sustained uptrend. Then we've seen the pair test the 55-89-day simple moving average band. Again, those purple moving averages from below. So looking for confirmation of the breakout. And that's what we got last week. We came back into that 55-89-day simple moving average band area, and then we moved lower once more. And what we saw after yesterday is a break of the most recent low from late August. So again, confirming that bearish trend that we've seen, with some very bearish indicators along the way, including the 38.2% retracement and the confirmation of the 55-89-day simple moving average band. In terms of what lies next, the next big test below for the pair is 123, 124, in my opinion. Now, this is where the 200 and 233-day simple moving average bands comes into play. That's the two red moving averages on the chart. Now, what makes those additionally interesting is that we've seen the pair respect the 55-89-day simple moving average band. So it'll be interesting to see if we see a similar effect on this 200-233. But then also it aligns roughly with the lows or the support zone in the second quarter of this year. So that's between March and June. You could see this on a number of occasions in late March, then in the middle of April, late May, and then going into early June. That 123, 124 area was a key level of support. So that therefore, again, stands out as a potential area of support going forward. Of course, if we do see retracements back, and so far they've been relatively shallow, if we see retracements higher than those previous lows around 126, maybe just a bit shy, around 125, 125.50, and that 126.15, the lows from earlier in August, do stand out as potential areas of support. But at this point in time, retracements have been shallow, and we've seen the continuation of those moves lower. So therefore, I think the big support zones is the one that stands out for me as being the most important. Finally, it's those momentum indicators that are going to be key. And at this point in time, if we look at the momentum indicators, the stochastic is continuing to make lower lows. The MACD moving averages are continuing to make lower lows, and the MACD histogram is making lower lows, or is about to make lower lows. So therefore, all of these indicators combined to add to the bearish narrative at this point in time that we are seeing in this currency pair. But of course, there's plenty more data to come over the next couple of weeks. We'll get US CPI, which is the most notable release of next week. We'll also get the Fed meeting the week after, which is going to be crucial. And any Fed commentary between now and the end of the week is going to be the last time we hear from those Fed policymakers ahead of the meeting later on in September. So anything they have to say in light of last week's jobs report, last week's JOLTS data as well, and this week's ISM number is going to be crucial in setting the groundwork for what we can expect from a commentary perspective from the Federal Reserve in a couple of weeks' time.